Good afternoon, everyone. My name is Gregory Leparati. I'm Associate Director of Alumni Relations here at Baruch College. Our office hosts a number of events throughout the year focused on networking, as well as providing career tips and advice. We're delighted today to be presenting on a topic that I know is of interest to many of our alumni, student loan repayment, which is a major issue across our country. Our presenter today is Thomas Kokis from Baruch's Financial Aid Services. Thomas is a default prevention and loan specialist here at the college, and he wants our alumni to be aware of essential tips and tricks that can help you pay off your student loans. Throughout this presentation, feel free to ask questions in the chat bar, and we'll find time periodically throughout the presentation to address them, as well as at the end. So without further ado, I present Thomas Kokis.
Thanks, Greg, and welcome to everybody who is out there on the call. I'm very happy to be here with you to share this information. Just to give you a little personal background history, I've been in financial aid, specifically the student loan industry, in a number of different capacities for over 30 years. So I think I'm well versed. I'm hoping I'm well versed in this material, and I'm hoping you'll all find this of use to you. So we should be about an hour. So let's begin the slideshow and go right into our agenda to just briefly go over what we're going to be covering today. First, we're going to go over some terms that I'm going to be using periodically through the presentation. And then we're going to get into what I call the basics. So, what we're going to be focusing on are the federal student loan programs. There are two types of federal student loans: the subsidized student loan and the unsubsidized. So those are, we're going to be spending most of our time talking about them. So we're going to get into the basics of those two programs. And then we're going to cover the different repayment plans that borrowers have available to them. So the whole point of going over these repayment plans is to help you structure a monthly payment that's affordable for you. You'll see you have a lot of flexibility and variety in choosing in choice of plans. So the plans fall under three categories: standard, graduated, and what are called income-driven plans. So we're going to speak a little about each of them. Then we're going to get into a federal program called the Public Service Loan Forgiveness program, get into that into a lot more detail. And then we're going to briefly talk about the differences between refinancing your student loans and loan consolidation. Some of you may have received solicitations in the mail or by phone, email from companies offering to do these services for you. So we'll give you some information about what the differences are between the two. Deferments and forbearance, will go over ways to postpone your payments if you're having difficulty making payments. Defaulting is something you should all avoid, and we'll talk about what that is and how you can avoid situations where you're close to going into default. Third-party providers and loan scams, again, I'm sure a lot of you have been getting solicitations from companies to do a lot of things for you. Some of them are legitimate, but there are others that are not and are frankly being investigated for their practices. And what we're going to emphasize there is that everything that they offer to you to do for a fee, you can do for free. And then just to give you a brief legislative update, these are federal programs in Congress, especially in an election year, and politicians are talking a lot about the reforming the student loan program because of I'm sure you've seen in the news all the stories about the tremendous amount of debt that college graduates are leaving school with. So we're going to talk briefly about some things that have been introduced in the Congress in the legislative update. So let's get into terms. Again, these are just some basic definitions of some terms I'm going to be using through the presentation. The first term is called capitalization. And that is the addition of unpaid interest to the principal balance of your loan. The principal balance of a loan increases when payments are postponed during periods of deferment or forbearance, and unpaid interest is capitalized. So that happens anytime you postpone your payments. It's something that a lot of students are not aware, or borrowers are not aware of. So it's important to understand that process or that transaction, especially when you're thinking about postponing your payments. Negative amortization, the increase in the principal balance of a loan caused by a failure to make payments that cover the interest due. The remaining amount of interest owed is added to the loan's principal. So your monthly payment is typically, made up of two components: the interest that is accrued over the previous month and the principal. So your payment has to cover any interest that accrued during the previous month. If it doesn't do that, then you're in a situation of negative amortization. So any interest that was not paid gets added to your principal balance, increasing the size of your debt. So that's, we'll talk about that and how that works in the context of the income-based repayment programs that we're going to go over. And then the loan servicer, and these are the entities you're dealing with in repayment. So, you're borrowing money from the federal government. So the government, Uncle Sam is your lender, but Uncle Sam needs a way to collect payments. So what they've done is contracted with private companies to do that service on their behalf. So the names that you see in the green box are the loan servicers that are currently under contract with the Department of Education to collect student loans. So these are the companies that you're going to be dealing with in repayment. I'm sure a lot of these names look familiar to you. So any payments you make or any conversations you have regarding your student loans should be handled through your loan servicer. And we're not moving forward. There it goes. Okay, the basics. So let's go over, and a lot of this may seem, you guys may already know if you've done like an exit interview for your student loans when you left school. So let's talk about, again, we're going to focus on the subsidized and the unsubsidized loans. What's the big difference between the two of them? If you look at things like interest rates that you're charged and the length of the repayment term, all those things are pretty much the same across both programs. The key difference goes to the term subsidized and unsubsidized. So for the subsidized program, while you were in school and any time you've postponed your payments, interest continues to accrue on the loans, but the interest is paid for by the government. So the subsidized program comes with an interest subsidy. So that's a good thing for borrowers. You're not adding additional, cost to your loan anytime you postpone payments. So the three times that a borrower typically postpones their payment is when they go back to school. You go back to school at least half time. And pursuing a degree, you can postpone payments on existing loans, and any interest that accrues on the subsidized will be paid for by the government. And then there are periods of deferment, things like unemployment, economic hardship, and we'll go over those in a little more detail when we talk about deferments. The unsubsidized loan, yeah, you can postpone payments on that loan, but any interest that accrues will be added to the principal balance, so that capitalization process would occur. So that, in that case, any interest that wasn't paid for gets added to your principal balance. So that's the key difference between the two programs. The repayment term for both is 10 years. You have a fixed interest rate. So borrowers typically have more than one loan. A lot of students think they have one student loan. In fact, what you do have are multiple student loans, and those loans, each loan could carry a different fixed interest rate. So that's something to keep in mind. So your monthly payment covers all those multiple loans and any interest that accrued for all the loans that are under your name. So borrowers, your loans are assigned to a loan servicer, one of the companies that we looked at before. The government does try to assign all your loans to one servicer, so you have one monthly payment to make and one phone call to make if you need assistance. You may have more than one. That really it depends on your borrowing history, how far back you go in terms of being a student loan borrower. And all payments should be made to your loan servicer. If you're not sure who your servicer is, there's a website you can go to. It's called NSLDS. That stands for National Student Loan Data System. It's a Department of Education website. You would access it using your user ID and password that you use to file your FAFSA every year. And then once in the site, you would need your social security number, your date of birth, and your first name. And then you can get a comprehensive list of all the federal debt that you have across schools. So, if you attended other schools other than Baruch and borrowed there, you would see the loans, you would see the interest rates, the types of loans, and also the servicer for your loan, your loans in existence. Okay, so let's get into the repayment plans. Again, you've got a variety of plans to choose from. So let's go over the first one. It's called the standard repayment plan. This is a plan that everybody is assigned initially. So if you never contact your servicer to ask for any other type of plan, this is the one you get. So basically, it's a fixed monthly payment for 10 years. So it's 120 monthly payments until your principal and interest is paid in full. Under this plan, the payments tend to be higher than they would be under the other plans we're going to cover. But the benefit of this plan is you would have, after all is said and done, if you were to compare the amount you paid in interest over the life of the payment plan, it would probably be less than what it would have been under the other plans that we're going to look at in the next few slides. So in the example here, we have somebody who borrowed $35,000. You divide that by 10 years, so that's $3,500 a year, and you take that amount and divide it by 12, and you have a monthly payment. This is only accounting for the principal of $292 a month. So that's a payment without the accruing interest. So there's another plan. This is called a graduated repayment plan. This is also a 10-year repayment term. So the difference here between this and the standard plan is that your payments start low and increase every 2 years, and until you get to a point where you're in the 10th year and your loan principal interest is paid off in full. So each payment has to cover the interest that accrues. So this makes sense for people maybe who are just starting out in their careers and they're not at their prime earnings point, and they need lower monthly payments initially and can afford the higher payments later on as they progress in their career. So now for all these plans, again, as I said, you get the standard plan. If you want to make a change, you have to the graduated plan or the income-driven plans that we're going to discuss. You have to call your loan servicer and ask for the change, and they will have a conversation with you. They can do some modeling over the phone to give you a sense of what your monthly payment would be based on the different plans, and then you can kind of decide which plan makes the most sense for you. So let's go over the income-driven plans, because these are all relatively new. They've been introduced over the last probably 10 years, and you'll see we have about 5 or 6 plans to look at. They're very similar in concept, and you'll see a lot of similarities across the plan. They're all designed to give you a payment that's calculated based upon a percentage of your annual income. So again, Congress created these plans to give borrowers the opportunity to come up with an affordable monthly payment. The key thing about this plan is you have to renew these plans, is that you have to renew them every year, because they look at income to calculate your payments. So if your income changes from year to year, you have to be reevaluated based on your most recent income figures. So that's something that a lot of borrowers kind of forget they need to do. So they're on the plan for 1 year, and then because they didn't renew, they get kicked off the plan and put back on the standard plan. So you need to contact your servicer every year to renew the plan, and your monthly payments can change from year to year, because if your income's increased significantly, that's going to impact the payment, or conversely, if it decreases significantly, you can also see a decline in your payments. So you should always work with your servicer when you sign up for these plans, and all these plans come with loan forgiveness provisions. So that's a big thing in the news too, is how do I get my loans forgiven? We're going to go over the time frame for loan forgiveness for each of these plans in the next few slides. So we're going to give you a little history lesson. So these are the plans that are currently in existence. So the first plan was introduced in 1994. It was called the Income Contingent Repayment Plan. Then you had a period of time when, you know, there was no plans that were created. Then we had in 2009, the income-based repayment plan was, you know, the second of the 4 plans that are offered. Then a revision to that in 2012 came is the pay-as-you-earn plan. And then in 2015, we had the revised pay-as-you-earn or repay. The servicer will figure out when you call which one of these plans you qualify for. Most of you are going to be looking at the pay-as-you-earn and the revised pay-as-you-earn plans because you're recent borrowers. So if those are the kind of, we're going to kind of try to focus on those two in the next few slides. Okay, so again, your servicer can determine which plan you're eligible for. So if you have eligible loans, you know, when I say eligible loans, they're federal loans. You know, you can qualify for any of the plans listed. Another qualification is you have to show need, and the servicer will determine that. So if you show need, you qualify for the IBR or the pay-as-you-earn plan. And if you're a recent borrower, you qualify for the pay-as-you-earn. So some of these, I mean, the repay, all you need is the eligible loan. So if you have federal loans, you immediately qualify for that. So some of these other plans, the earlier plans have added conditions. Eligible loan programs, so the direct loans, so these are the subsidized and unsubsidized programs that you've all, I'm guessing, borrowed through, qualify for all the plans. The FFELP loans are loans that the program was discontinued in 2010. Those are loans that were made to you by banks because banks used to be involved in the program. So if you have any of those bank loans that you want to put on an income-based plan, the only one of these plans that they would qualify for is the IBR. And then if any of you have Perkins loans, those were loans made to you by the school. So it would have been loans made to you by Baruch. They can't qualify under any of these repayment plans. Okay, so, you know, if you receive the loans, the eligible loan type, if you receive the loan as a student, you know, you qualify under all the plans. If you receive the loan as a parent, there's a program called a plus loan. You know, if you were a parent, you borrowed a plus loan to help pay for a son or daughter's education, that loan wouldn't qualify under any of these income-driven plans. If you consolidated your loans with no parent loans, you can qualify for any of the 4 plans. And if you consolidated, and we'll talk about what consolidation is a little later, if you consolidated your loans with a parent plus loan as part of the consolidation, you can only qualify for the income contingent repayment plan. Okay, I've got a lot of colorful slides. So let's go to, again, we're talking about those, we mentioned the interest subsidy that comes with student loans, specifically the subsidized program. There are cases, if you're on one of these plans, where you can get help paying the interest from the government. And this occurs in instances where there's a negative amortization. So let's say your monthly payment is calculated looking at your income, and the monthly payment does not cover the interest that accrues during the month. So the government will step in and help you with, making up the difference. So I'm gonna just focus on the pay and the repay plans, because again, these are the ones I think most of you will qualify for. So if you look under pay, where we have the little green coloring, green box, it's for subsidized loans. You do get an interest subsidy during periods of negative amortization, and you get that for the first 3 years under the plan. So the government will help you with those negatively amortized loans for 3 years, and they'll cover 100% of the interest that did not, that was not covered by your payment. Under the repay plan for the subsidized loans, you get all those, same benefits. So you get the 100% of coverage for negative amortization after the first 3 years. And then after that, you actually get a 50% coverage for negative amortization going forward. So it's kind of a permanent benefit under that plan. And under the repay plan for unsubsidized loans, you actually get help with the negatively amortizing interest. So you get up to, and there's no time limit here, it's you get 50% of the negative amortization, you get a subsidy for that under the repay plan. So, obviously the repay plan in terms of interest subsidy benefits is the richer plan. And I'm sure, because most of you are recent borrowers, many of you would qualify for, the repay plan. Interest capitalization. So if you're in a plan and then suddenly you're no longer in the plan and any interest accumulated or accrued, that interest actually gets added to your principal balance. So that's something to keep in mind. Again, let's focus on the pay and the repay plans. Excuse me, my earplugs keep falling out. So if you're in the pay or the repay plan and for some reason let's say you failed to renew it, or you're making your income no longer, you see a bump up in income and you're no longer eligible for the plan, because that can occur. Any interest that accrues that accrued during your time in the plan would be added to your principal balance. I mean, that's the major rule that you guys need to consider. So, I mean, I'll stop here because I know I showed a lot of colorful slides and just wanted to get a sense from the group if there was any questions up to this point.
No questions yet, Tom. We had a few people ask if we'd be sharing the PowerPoint afterwards, and I said we would do that. If anyone has any questions, feel free to put it in the group chat and we will address it.
Okay. All right, let's go let's move forward with a little more on the income-driven plans. What we're going to do now is kind of show you how your monthly payment is calculated under these plans. And we're going to look at a term called discretionary income, because that's what the government uses to calculate how much your monthly payment will be. So this chart here shows you how much of your, in percentage terms, how much of your discretionary income is used to calculate your monthly payment. So under the revised pay-as-you-earn plan, repay, it's 10% of your discretionary income. Under pay-as-you-earn, it's also 10%. Under the IBR plan, it's 15%. And under the income contingent repayment plan, it's 20%. So you can see, the more recent plans, the percentage of discretionary income is lower. So let's talk about the forgiveness provisions under these plans. So, let's look at the repay plan. If you're on that plan for anywhere from 20 to 25 years and you have an outstanding principal balance left over, that amount gets forgiven. So that's what, that's what is meant by forgiveness under these programs. So for the pay-as-you-earn plan, it's 20 years. For the income-based repayment plan, it's 25 years. And for the ICR plan, it's 25 years. So let's, I use the term discretionary income. Let's show you how, what that term means and how the government calculates discretionary income for borrowers. So what, basically what they do is they look at a table of poverty data that is issued every year by the federal government. It's called 150% of the poverty guideline for family size and state. What I added to the slide is a picture of the chart. So this is Bureau of Labor Statistics poverty data, and it's revised and released annually. So whatever your number is, and we'll show you how that's calculated, it gets subtracted from the borrower's adjusted gross income to calculate your discretionary income. So in the next slide, I think we have an example of how this all works. So we've got John Borrower. John Borrower has $60,000 of student loan debt. He's on a standard repayment plan. I used a 5% fixed interest amount for his interest. So taking these all into account, for 10 years of payment under a standard plan, his monthly payment would be $636.39, which is, kind of a high payment. So let's say John calls and wants to see if he qualifies for any of the income-driven repayment plans. He calls the servicer. The servicer asks him questions like, what was your adjusted gross income for the most recent tax year? And John tells him 40,000. Okay, do you have any dependents? No, John's single, just was on his own. So they take that information and they look at the chart that we showed you before, and they look at size of household, and they look at the 150% figure, and they just, you just cross over to 150% size of household. So the 150% poverty guideline figure is 18,210. So you take that figure, you subtract it from the AGI, you have $21,790 of discretionary income. Under the pay plan, again, remember, it's 10% of the discretionary income is deemed available for student loan payments. So it's $2179 as an annual amount. And then to get the monthly payment, you just divide that by 12 and you get a monthly payment of $181.58. So that's a lot lower than the $636 figure that we quoted under the standard plan. So John can get some significant monthly repayment relief by signing up for this particular plan. So that's it for the income-driven repayment plans. So next we're going to cover public service loan forgiveness, or PSLF.
You know what, Tom, we do have a few questions that came in. So how about we tackle some of these? You might have already answered some of these a little bit, but one person asked, how is discretionary income determined?
Again, let's go back to the slide. So again, it's based on your adjusted gross income and the number that you support on that income. And, the servicer will look at these poverty figures, 150%. And, in this example with John Borrower, he's a single person, 150% figure for a single person is 18,210. So that number gets subtracted from his income to come up with a discretionary income figure of 21,790. Under this plan, it's 10% of that number that is available for student loan payment, 2179. Then you divide it by 12 to get the monthly payment, and that's kind of how it's all calculated. So the discretionary income figure is your income minus the 150% of the poverty guideline figure for your household size.
Another person asks, so you have to keep applying for these programs every year for 20 to 25 years and qualify for it in order for the balance to be forgiven after 25 years?
That's correct. Yeah. So if you're, on these, you'd have to be on the plan for anywhere from 20 to 25 years. You'd have to have a principal balance outstanding at the end of that time. And if you do, then that amount gets forgiven. But yes, you have to renew, you have to qualify every year, and be on the plans for that length of time and have a balance outstanding at the end of that time to get any loan forgiveness.
Gotcha. We got another question that said, why did you go with the 150% option?
Because that's what the government has mandated in the regulation. So this is what is said that should be used. It has to be used to calculate these numbers.
Gotcha. And last question, someone asked, there is a lot of different methods of loans. Is there someone I can go to and discuss which is best?
The servicer is your first point of contact, I think, and they all have great customer service departments. I interact with them a lot over my years, and have been on the phone while they've talked to borrowers. They can, go over all this information, give you quotes on what your payments would be under these different plans, how to apply. So, I would recommend, obviously, if you want to come by to our office and you need to sit down with somebody like myself, I'd be happy to do that with you. We don't like to recommend one plan over the other. We can just kind of give you the information that you need to make an informed decision. So but you can certainly, anybody can certainly come to the office and can go over these plans in more detail.
Thank you, Tom. That's all the questions for now, so you can proceed. If anyone else has any other questions, feel free to ask it in the chat bar.
Okay, thanks, Greg. Okay, so we're gonna go over this program. It's another avenue to loan forgiveness for borrowers. It's called the Public Service Loan Forgiveness Program. This is also a government, federal government sponsored program. It's been around since 2007, and basically the concept here is in return for a period of service on the borrower's part, borrowers can have a portion of their student loan debt forgiven. And this, again, another colorful chart shows you all the components of the PSLF program. So this is how it works. You have to make 120 qualifying payments. So we're looking at a 10-year window of making payments on your direct loans. You have to be in a qualifying repayment plan, and we're going to go over all of this stuff in the next few slides. And you have to be working for a qualifying employer, and we'll talk about what a qualifying employer is. And you have to do all these things in order to, receive any kind of forgiveness through the Public Service Loan Forgiveness Program. So if you do have, after 10 years of payments, and you have principal outstanding, that amount gets forgiven, and it's not, for the IRS, it's not taxable at the time of forgiveness. So what are the eligible loans? I mean, again, it's the direct loan. So if you have direct loans, you qualify. Any of the other older loans, the PLUS loans, no. Perkins loans, no. FFELP loans, no. If you do a loan consolidation and you consolidate all these loans, they can become eligible for public service loan forgiveness, because you're essentially changing the loan from those categories to a direct loan. So those are the qualifying loans. All right, so let's get into what's qualifying employment. So it's not what you do at your place of work, it's the kind of organization you work for. And I guess the largest qualifying employer would be any government organization. So if you work for any entity of a federal, state, or local government, you could be, I don't know, head of an agency, or you could, be just a clerical worker. Again, it doesn't matter what you do, it's the organization that you work for. That any government job essentially would be a qualifying, considered qualifying employer under this program. Another qualifying employer would be a non-for-profit organization. They have to be under the specific IRS category of 501c3. So typically those are charitable organizations that don't pay taxes. So if you work for them, you could be the president of that organization, or you can, again, be at a lower level and still have them as qualifying employers. And then any other non-for-profit group that doesn't fall under a 501c3 category, but performs qualifying services, and I've listed 4 of the services. This is not an all-inclusive list, there are more, but just to give you a flavor of the kind of work or organizations would qualify. So, let's look at the New York Public Library. If you worked at the New York Public Library, which is a non-for-profit, I don't think it's a 501c3, it may be, I'm not sure, but if it's not, it's a non-for-profit for sure. And if you work there as a librarian, you could qualify for public service, loan forgiveness, school libraries, emergency management, or in working in the public health arena. So these are the types of jobs that qualify as as qualifying employment. You got to be full-time at your job. The definition of full-time under the program is it's the greater of the employer's definition of full-time or 30 hours a week. You can work at, let's say you maybe have a couple of part-time jobs and your total hours worked a week is 30 or more hours. You could qualify as long as each of your part-time employers is a qualifying employer. For borrowers at nonprofit organizations, hours spent in religious instruction, worship, service, or proselytizing don't count. So, you can't use those types of organizations to qualify for this program. Okay, so we said you have to be under a qualifying repayment plan. So basically the plans that we covered earlier, the 10-year standard, the IBR, the ICR, pay as you earn, or the repay plan. Now, to kind of put yourself in a position to achieve your goal of loan forgiveness, it's usually advisable to put yourself on one of the income-driven plans, because they're most likely to yield you a principal balance, an outstanding principal balance at the end of the 10 years. If you're on a standard plan, you remember it's a 10-year plan. Your principal and interest is going to be paid off in 10 years. So, and you have to do 10 years under PSLF to qualify. So if you're on a standard plan for 10 years and you paid off your loans, there's nothing to forgive. So the income-driven plans are the most likely to yield a balance for forgiveness. Some more information about qualifying payments. So again, you have to make 120 separate monthly payments. They have to be made after October 1, 2007. Basically, that's when the program started. They do not need to be consecutive. What that means is you could, let's say you worked for a qualifying employer for 3 years, you made your payments under the plan, then you left that job and you maybe took some time off or worked for a non-qualifying employer for a couple of years, and then you changed jobs again, and then you were back to working for a qualifying employer. Those payments can count. So you had a break, when you change jobs between qualifying employers. It doesn't mean that's going to count against you in terms of disqualifying you from the requirement for monthly payments. So that's kind of a good thing about the plan. You got to pay the full amount due under the plan, and your payments can't be more than 15 days late of the due date in order to be counted as a qualifying payment. Multiple partial payments count as one payment. They all have to be received within 15 days of the due date. Payments when not required do not qualify. This is important. If you make a lump sum payment, it only counts as one payment. Exceptions to that rule is if you work for organizations like the AmeriCorps or the Peace Corps or Department of Defense borrowers. So another component to all of this is your employer has to be certified as a qualifying employer. I mean, there is kind of a review of the organization to make sure it meets the requirements of a qualifying employer. So if you're interested in this plan, there is one servicer that has been selected by the Department of Education to act as the servicer for public service loan forgiveness, and they are Fed Loan Servicing. So you may have loans with another servicer. If you want to, apply for this plan, what would happen is, if you do qualify, all your loans would be transferred from your existing servicer to Fed Loan Servicing. So here's kind of like a flow chart of how that would all work. So the borrower submits their initial application to Fed Loan Servicing. What you're doing is you're submitting the application to determine whether your employer is a qualifying employer. And Fed Loan Servicing does the rest. They're going to determine whether you have direct loans, if your employment qualifies. If all that occurs, then your loans are transferred over to Fed Loan Servicing. Then Fed Loan will also determine whether you made qualifying payments, all your qualifying payments during the employed period. And every time you change jobs, you have to, submit a new application for the new employer to see if they qualify as a qualifying employer. So the next few slides are just, the actual application to to make sure the certification form for your employer. So this is the first part. Section 1 is basically the borrower information. And you have to sign it. This is the certification and the understanding. So this gives you the general specifics about public service loan forgiveness. You sign and date it. And then this is the part that needs to be completed by either the borrower or the employer. The employer, I mean, you could take this to the human resources department, and they would be probably best able to complete it. And then there's the certification that needs to be signed by the employer before it can be sent on to Fed Loan Servicing. And here's the address. Okay, some common program misperceptions. All federal loans can be eligible through the direct loan consolidation. Again, if you have Perkins loans or FEL loans, if you do a consolidation and create a new consolidation loan, all those loans that formerly were not eligible would be. Qualifying employment is not about the specific job. Again, we talked about that. It's not what you do at your job, but who you work for. The qualifying repayment plans, we covered that. It's, again, under the income-driven plans, you have the best chances of having loan forgiveness down the road. Consolidation will erase any qualifying payments already made. And you shouldn't wait if you're employed with a qualifying employer to submit your application, 10 years after you've been there. You should do it as soon as possible to make sure that all your payments are, considered qualifying payments. Okay, so that's it for public service loan forgiveness. I guess we can stop here and see if there's any questions on PSLF. Right?
Yes, we have a couple of questions. So the first question we have says, how realistic is it to qualify? Recent news coverage has reported that a very small number of people have been able to benefit from PSLF.
Yeah, the news has been more people, the number of applications has not been what federal authorities thought they would be. Yeah, I mean, I don't know specific percentages of, what amount of debt you would need to get to a point where you still have remaining debt that can be forgiven after 10 years. I believe there are studies out there that kind of do some modeling to see, what I guess the break-even point would be. If you have high debt, I mean, I would say if you have over $20,000 in student loan debt, it's something to look at least, then you can have conversations with the servicer. Maybe they can kind of do some modeling to see if you would have forgiveness down the road. It's kind of a difficult thing because your income can change from year to year. Remember, you have to be on an income-based repayment plan to have a better chance of having loan forgiveness. But if your income changes significantly from year to year, I mean, that creates kind of, some uncertainties in predicting the future.
Another question we got says, does working for the city apply for this?
Should. City agency, yeah. It's a federal, state, or local government authority. So yeah, if you're a city worker, I would definitely submit a form to Fed Loan Servicing to make sure it's a qualifying employer, but I can't imagine it wouldn't be.
Yeah, the alum clarifies and says CUNY, for example.
CUNY, yeah, for sure.
Yep. Excellent. Okay, that's all the questions for now. Anyone else, if they have any questions, feel free to put it in the group chat and we'll address it next time we pause.
Thanks, Greg. Okay, let's move on. We've got a couple more topics we're going to cover. The difference between refinancing versus loan consolidation. Again, some of you may have gotten solicitations from private companies to do a refinance of your student loans. So let's, there are differences between refinancing and consolidation. So under the refinancing scenario, what you're doing is you're taking out a new loan to pay off existing loans. And when I say existing loans, we're gonna focus on the federal loans, the sub and the unsub. You can do a refinance with private loans if you have them, but if you do it with federal loans, what you're doing is creating a private loan from existing federal student loans. So that's something that you're converting federal loans into private loans, and that you should be kind of weary or do your homework before you do that. Why? Because once you make that change, you may lose some of the benefits that you had under the direct loan program, with things like the income-based repayment plans and loan forgiveness that you wouldn't get under a refinanced loan offered by a private company. So each one of these private companies sets their own terms for the loan. I mean, so you would need to do your homework on the refinancing entity. What are they offering? Do they have something similar to income-based repayment? If I have trouble making payments, can I postpone my payments? All those kind of bells and whistles you get with the federal programs. You may want to, investigate to see if you would lose those if you did a refinance. Why do people refinance? Well, I mean, what's the benefit? What you're looking to do is if you refinance, you're trying to get a lower interest rate on your loans. So if you're somebody with great credit, because when you refinance, you're going to have your credit pooled to determine what your interest rate will be. If you have great credit, you may be able to leverage that good credit to get an interest rate lower than what the rate is on your existing federal student loan. So, the goal here is to lower the total interest cost to you if you refinance. So, it's something to consider. But again, I wouldn't rush into this. You should always do your homework when considering a refinance. The consolidation program is a federal program. It's been around since 1986. So what you're doing is you're just taking a new federal loan to pay off existing federal loans. Why do people do that? Basically, it's to resolve an issue where borrowers have more than one student loan servicer. You have multiple payments every month, which can be kind of a headache if you want to apply for a deferment or a forbearance. You have to make multiple phone calls, so it makes repayment easier for borrowers. The interest rate that is assigned to your consolidation loan has nothing to do with your credit. There's no credit check done. Basically, what they're doing is taking the weighted average of the loans that you're consolidating and rounding it up to the nearest 8%. So you'll get something that's kind of close to what your total interest costs will be if you don't consolidate. Because this is a federal, consolidation is a federal loan, you still have all those, the bells and whistles. You have the deferment and forbearance options, they're still there. You still have the income-driven repayment plans. And under consolidation, you can have, you actually have more repayment plans to choose from. They're called extended repayment plans. You're still under the federal umbrella if you consolidate, as opposed to, with refinancing, you remove yourself from that federal umbrella. So, always consider the financing. You may lose things we just talked about. If you're going to refinance, do your homework, understand the rates in terms of each provider, read the fine print, know your credit score. If you've got a low credit score, you don't want to refinance because you're going to get a higher interest rate. So work to bring your credit score up before you consider refinancing. You should also, ask if the rate that you're going to get is a fixed or a variable rate, because it could be either or. Refinancing may be a good idea if you can leverage your credit score and get a lower rate. If your job is relatively secure and you don't think you'll be in situations where you have to postpone your payments, or you run into trouble work-wise, it may make sense to do a refinance. Okay, so let's talk about deferments and forbearance. Again, the federal program, you can postpone your payments under certain situations. So if you're unemployed, you can qualify for an unemployment deferment, so your payments are postponed. You're given a 6-month Postponement, if you need to renew that, you can. You get a total of 3 years' time. It doesn't have to be consecutive. So if you're, find yourself unemployed or underemployed, if you're working less than 30 hours a week, you could qualify for an unemployment deferment. Then there's something called economic hardship. Again, the government will determine whether you meet their definition of economic hardship. This is also, you get a total time of 3 years. This is given out in yearly increments. If you go back to school and you're going to school at least half time, you can, again, postpone payments on existing loans because you're back in school. You have to be pursuing a degree, so you have to be in a matriculated status. If you find, you call your servicer and you don't qualify for any of these deferments, you can ask for something called a forbearance, which is granted at the servicer's discretion. There's no interest assistance from the government. If you're in a forbearance under the deferments, you do get the government kicking in and paying the interest that accrues on any subsidized loans you have during the period of deferment. But that does not happen under a forbearance, so any interest that accrues, the interest will be capitalized, added to your principal balance, making the amount you owe greater. So defaulting, so this has also been in the news a lot. Default rates for schools is a concern with the politicians in Washington. What is defaulting? Let's define that term. If you have a borrower who has not made a monthly payment in 360 consecutive days, they go from a delinquency status into loan default. Servicers, the company you're making your payments to, if they don't get a payment from you after 3 months, your monthly payment is 90 days past due, they start reporting that non-activity to credit bureau. So you start to damage your credit at 90 days past due. And if you continue to be past due for 360 days, you fall into that default status. So defaulting can result in wage and tax refund garnishment. Your loans will be placed with a collection agency who will make aggressive efforts to collect. And you can find yourself being subpoenaed or sued rather to reclaim all the money that you borrowed plus interest and any collection costs. So you can see defaulting is not a good idea. Anytime you find yourself falling past due on payments, don't hide from the problem. Contact your loan servicer. Solutions to the problem: you could be put on a income-based repayment plan, or you can ask for a payment postponement under one of the deferment or forbearance provisions. So try to avoid falling past due at all costs. Student loan scams. Again, there are companies out there that have been reaching out aggressively to borrowers to say, we want to help you. You should be weary of them. Anybody who promises to give you loan forgiveness really quickly, they're not offering you. Basically, they're not telling you the truth, because the only way you can have federal loans forgiven are the ways we discussed under the income-based repayment plans and under public service loan forgiveness. So, the earliest you can have a loan forgiven is 10 years. Never pay a fee for assistance. All these companies are, they're going to offer you services, but in return, you're going to pay them a fee. And in some cases, it's a pretty hefty fee. All the services that they're offering to do for you, you can do on your own by just contacting your loan servicer. They'll put you on a income-based repayment plan. They'll see if you qualify for public service loan forgiveness, because that's basically what these companies are offering to do for you. They'll call your servicer, and they'll basically be acting as your agent to put you on an IBR plan or sign you up for public loan forgiveness. A lot of these companies put phony logos that look like a government logo to trick borrowers into thinking that they have they're representing the federal government. So be cautious of that, and never obviously never share any kind of personal information, social security numbers, or your FSA user ID and passwords with any of these anybody who solicits that information from you. Okay, so we're at the last part. A legislative update now. I just chose a couple of things that are out there that have been talked about in Congress. I mean, these are federal programs, so there are committees in Congress both on the House and the Senate side that deal with this stuff all the time. There's always new bills introduced to reform or modernize the plan. So, you know, if you're, I'm not saying become a government junkie over this kind of stuff, unless you want to. But you know, keeping an eye on these kind of things can, you know, help you in terms of your planning. What I've done is just come up with a couple of things that have been talked about. Who knows if they'll pass? You know, we're kind of working with gridlock government of late. But these are, you know, some of these two acts actually have some bipartisan support. There's the Employer Participation in Repayment Act of 2019. So this is kind of a very unique idea. So it would allow employers to pay down student loan debt tax-free. So you work for a company, you graduated from college, you have student loan debt. The company would be able to pay off a portion of your debt as an employee benefit. So this kind of, this does is just change an existing law where, you know, right now many employers offer to pay for you to go to school to help you pay tuition, and they can pay you can receive up to $5,250 a year tax-free. So instead of, you know, using this benefit to pay to go to school today, you can use the same benefit to pay off existing student loans that you took out when you attended school in the past. So like I said, this has, you know, bipartisan support, so this is something to keep an eye on. And then there's something called the Student Loan Refinancing Act, which, you know, you can refinance and try to get lower interest rates on your existing student loans. So under this bill, you can refinance at any time during the life of the loan, and you can refinance only once every 6 months. So if, you know, interest rates start to go down and you know, you can do a refinance, you may be able to reduce rates on existing loans. And I think you all are all aware that we are in an election year, and there are a lot of politicians out there making promises about, you know, erasing student loan debt. Whether that's going to happen, it, you know, obviously depends on who's elected, the makeup of Congress, and the cost, because, you know, we're talking about over $1 trillion in debt is the number that gets passed around. So, you know, who knows if and when that'll happen, or, you know, what if all of it or some of it will take place. But it's, you know, obviously it's an issue that is garnering, you know, attention at the presidential level. So just something to keep track of. And I think that's it. We're at the end. So
all right, wonderful. Tom, we do have a few follow-up questions here. One person asks, what if you only update your repayment plan every couple of years? Do you still qualify for forgiveness?
I think it has to be consecutively. You have to maintain a consecutive status in the plan. So if you were to fall off the plan and come back, oh, you mean in terms of the income qualification? Is that what they mean?
That's a good question. Maybe the alum could follow up to me.
Because if it's a question of, you know, you just didn't renew, that's different from you were disqualified because of income, and then you maybe had a change in income later on down the road that made you eligible again.
Right. Well, maybe the alum could respond to me to clarify that situation. In the meantime, another question asks, do you recommend consolidating my undergraduate federal loan, which is 3.75%, and my graduate federal loan for 6.2%?
Well, you'd have to do the calculation. Again, it's the weighted average, and there are calculators on the web that can help you, you know, kind of get a feel of what the weighted average. Now, again, it's not only the interest rate that is a factor, it's the amount of debt you have under that interest rate. So if you have more debt from graduate school than you did undergrad, let's say you've got $60,000 of total student loan debt, 20,000 was at the undergraduate at 3 and 7.6%, and the graduate debt of 40,000 is at the 6 or 7% level. You know, that's going to factor in as well. in calculating the rate. So it's not only the interest rate, but it's the amount of debt that you have under that interest rate that determines the ultimate outcome.
And the alum clarified from the earlier question to say that she simply did not renew.
I'm thinking that you would have to, and I can check, I'm not sure, but I'm thinking that you would, be starting the clock over again if you were just to, come back on the plan. I'll check.
Another alum asks, let's see here, wants to know, is there a matrix of all the pros and cons of the various types of loans? Like, for example, loan limits, some loan accrued on day zero when you're at school and some accrued after you graduate, etc.
I'm not familiar with any kind of matrix like that. And we have charts on the Baruch site that shows, what you can borrow every year as a graduate and an undergraduate student. So anything more detailed or complex than that, I have to do some investigating.
Another alum asked if we could explain the federal refinance program again quickly.
Okay, so it would be the consolidation program because there's no federal refinancing. Mm-hmm. If you refinance if you go with a private company that's not, it's not an agency of the government, and you take out, what you're doing is you're taking out a private loan to pay off existing federal student loans. You're essentially you're converting your federal student loans into a private loan. So in that scenario, you may lose some of the, the benefits that you get under the federal umbrella, the income-based repayment plans, the forgiveness options, the deferments, the forbearance. So, I mean, you're working in a totally different environment if you do that transaction. The consolidation loan, you're just, exchanging one federal loan for another. So you're still under the federal umbrella in that scenario. I'm hoping that answers the question.
I think so. Excellent. And just to also answer a few other questions that came in, this recording of this webinar will be sent out to participants, so no worries. Excellent. Okay. Well, thank you, Tom. That seems to be all the questions. If anyone has any follow-up questions after this, feel free to reach out to me or Tom. We'd be happy to answer any additional questions you have. I'd like to thank Tom for this wonderful presentation, a lot of great information. I'd like to thank all of our alumni for tuning in. Thanks so much for your questions and for being such an engaged audience. So we'll follow up, as I mentioned, with a recording of this webinar. We'll also provide some information about other upcoming alumni events. We hope to see you again on campus soon. So have a great rest of your day.
Thank you.